Good morning. It's Friday, May 15th, 11:10 a.m. It's been a while since I've done one of these video podcasts. So I was going to work out, actually, go lift weights, and I'm still going to do that right after this and grab lunch. But I wanted to record something just to get back in the routine here. And I wrote an article earlier this week. Um, I the market price action has been extraordinary. We're 7 weeks in a row kind of higher. I wrote that piece on March 29th that said there was too much pessimism in the markets. And since then, it's been straight up. It's actually, it's been more remarkable than anything we saw in 99 2000 for the simple fact that the persistence of the advance has just been, it's gone up without volatility to the downside. Realized volatility to the upside has been 10 to 1 to downside volatility. And there's just a statistic out there that we've had in the S&P 500 eight 1% gain days here without a 1% down day. We'll see if that changes depending on how we close today. And there's a lot of movement in the other markets beside the stock market, and interest rates and oil. Oil's been a lot stronger than I would have thought given where the market is. Um, I saw a post. Jeff Curry's on Twitter now, and he's the former head of the Goldman Sachs uh, commodity unit. And I used one of his in my opening quotes. I've used one of Jeff's quotes, and he said it's difficult enough to trade commodities, um, as an investor. And he said it's even more difficult when you're an expert, right? And I think we've seen some of that where you get close to it, and the moves are more extreme than you would think. But I saw a post from Jeff, and I wrote that article when Exxon was taken out of the Dow in August of 2020 and replaced by Salesforce. And I said that, this was something that we'd look back on in history. That's certainly been the case, with Exxon up north of 300% since then, and Salesforce actually down. But Jeff, he pointed out that since October of 2020, commodities are actually up 210%. The Nasdaq's only up 125%. Now it doesn't feel that way, especially with the recent vertical run we've had in the Nasdaq here. So just keep that in mind. That it, I think it's been the golden age of active investing since 2020. Coming out of the COVID pandemic, and we've seen these extraordinary rallies. Both coming out of COVID, although again there was a lot more up and down volatility. We saw it coming out of the tariffs in 2025. Then we've seen it this year in 2026. We didn't go down as much as we went down in the indices during the tariff, event. And again, the persistence of the advance and the upside has been higher this time. There's some mechanical factors in the market that are affecting that, including the zero DT options, the leverage index products. Um, and those are both in the US and then outside the US on exchanges like the Korean exchange. And I saw a statistic, and I wrote about it in chat, but they said that it's remarkable because three stocks, Micron, SanDisk, and Intel, have had more options volume than you've had traded volume in the S&P 500 ETF. So it's been kind of a low volume melt up, but again, the mechanical nature of that has reinforced itself. I remember last Friday, you know, intraday, the put to call ratio was like 3 to 1. So people are hedging on an intraday basis because they know the market's so extended with zero DT options. But then, as those run to expiration, it's almost like guardrails on a bowling alley where they're, as long as it's kept between that, we continue advancing here. And obviously, the advance in the broader markets has been led by the semiconductor sector, which has been extraordinary, too. And the semiconductor sector is historically overbought now. There's only been one incidence where it's been more overbought. That was in 2000. And, you know, it's easy to get unmoored right now. I talk to investors. Some are doing well and they don't feel great. Some are doing poorly. They don't feel great. Um, the volatility is opportunity. It's obviously hard to trade through though, and you can be on the wrong side of things, and it feels um, really difficult, but you have to understand that the pendulum can swing the other way too. So you have to, if you're down on something, not get too down about it. If you're up on something, don't get too exuberant about it. You have to have, an even keel to navigate this environment. So uh, I just wanted to reinforce that. Obviously, in some of our stocks, we've seen tremendous price action both ways, you know, and so it's an opportunity, um, as we go through this, but there's risk as well. Someone's calling my phone, so it distracted me for a second here. But again, just try to keep an even keel. And when you see the extremes in price action, think of how that relates to what you're doing investment wise, but also think of how you can use that either, from an opportunistic perspective, um, and then, you have to think, you know, uh, that the extremes in motion will sometimes stay in motion until that breaks. And in 2000, we saw, people often ask me because I traded very actively 95, 96, 97, 98, 99, mostly on the long side. I was short personally in November of 1999, which was 4 or 5 months too early. One of the great learning lessons of my life. I was short like Digital Island, Intraware. Uh, I saw a stat that people said, well, this isn't, 99 or 2000 because there was like 117 IPOs that doubled, back then. But the IPOs that are coming out now, in terms of the sheer size of float that they will bring to the market, so SpaceX, Anthropic, OpenAI, cumulatively they dwarf the impact that we saw from IPOs in 99 or 2000. So, you know, you can understand why the underwriters there are rushing, these IPOs to the market because it's obviously a red hot market. But again, that can change. And in 2000, the price action itself was probably there was not a single catalyst that you know stopped that advance. It was just the price action kind of unfolding upon itself. And you have that same potential backdrop in the semiconductor space. I know Michael Burry is famously shorted. Seems like, I subscribe to Substack, but I think he's had 5 tranches or so where he's shorted SMH at quite a bit lower level, and he's rolled some of those. I think 330 was his last kind of batch, and SMH is in the 550 range today. Even down, a decent amount today, so it's quite a bit higher. I think his go out to January of 2027 now. So just keep that in mind. I mean, he's got a view, right? He's been early, and you can have a view on something. You can be early. You can be wrong. That's a possibility. But you also can be right. And it might go against you initially. So. But in 2000, when the momentum broke, you saw a reversion to value, a reversion to commodities. We have similar data now that Berkshire Hathaway is underperforming the S&P and the Nasdaq by a similar amount that did. Berkshire is famously under Buffett's ending run here raised a lot of cash, and so there's striking similarities. There's differences too. The earnings now are stronger. I would say that the counter argument to that would they're more centric to a very narrow leadership. So, and there's some circular reasons that are driving earnings growth, along with some structural reasons. But anyway, I just wanted to check in. People have asked me, "Are you okay?" Yeah, I've been busy with family. I get a lot of questions about the markets, and I'm fascinated by it, like anybody else. I'm reading a ton, researching a ton, and you can get caught up in some of the price action, some of the movement, some of the extraordinary things that you're seeing. And again, this is, to me, this is more extraordinary now than it was in even 99 and 2000. I have to go back to 1987 really to see kind of a persistent advance. Obviously, we had the crash in 87. There's some interesting backdrop there too, because, famously interest rates had risen back then. We're seeing the Japanese yields higher today. And in this advance, we've seen our treasury yields moving higher. That's hurt parts of the market. And then even beyond that, the only other kind of move with the persistency of the advance and the realized upside volatility compared to downside volatility was 1982, which was the start of the secular bull market. And I don't think it exactly parallels 87. I don't think it exactly parallels 99, 2000, although I think that's the closest parallel. And I don't think it parallels 1982, but it's interesting that we're touching on some of these seismic, eras of the market. So it's natural to feel, like things are out of control. It's natural to feel like you don't have a handle on things and things don't make sense, because we are really in a unique era. And I think, again, that will be opportunistic. It also has risks. And, it's going to create a lot of, discussion and debate on both sides, and that's similar to when we were coming out of March of '08, March of '09, when QE was introduced, and that really, goosed the market. And a lot of people thought that would be inflationary. I was invited to some panels. I remember going to a farmhouse in New England and in a big debate with some famous investors on the inflation deflation. And we're at a similar structural standpoint in the market where people don't know exactly how this data center build out will play out with its impact on the real economy and if that falters. So I'll try to do another one of these updates next week, just to check in. I'm going to try to write something this weekend, and keep tabs on what's going on, and appreciate, everybody in our group. Thankful and grateful. Appreciate the messages, the dialogue, the debate, the discussion, and everybody have a nice weekend. Thanks.